Hey everybody, happy Friday. I had some technical difficulties, sorry about the delayed start. I'm so happy to be back in the office, getting back in the swing of things. After the hurricane, our lights come back on, everything just kind of keeps going as normal. So keep your prayers going for people that are obviously still struggling because of these storms. This is a real thing that people are going through, and in Puerto Rico, keep your prayers going. It's so easy to get back into our everyday routine, and just don't lose them in your prayers, please. So today, with the market being so high, hitting all-time highs, I would like to talk about how you can make a plan for when it goes down, because the market eventually will go down. It doesn't just keep going straight up. And this is probably one of the largest concerns that I get from clients, and you can hear it all right? Okay, good. Probably one of the largest concerns and questions that we get from people is, what do I do if the market goes down? And I think that is a turning point in people's financial life, because if they don't have a plan, when the market goes down, you end up making irrational decisions based on panic and emotion instead of a strategic plan. So today we're going to talk about several strategies that may or may not work for you. They're not recommendations, they're more to pique your interest, to give you some ideas of what you can do and what's out there, okay? And I have to tell you that we tried to do a podcast on this yesterday with my wonderful husband, and it didn't end so well, so he's not here. He's going to be in the comments, I'm sure, behind the scenes. But those of you that know Jim probably understand my struggle, right? Anyway, I love you, honey. So let's get into it. So, first thing, when you need to have a plan for when the market goes down, if you are the type of person to panic when one day in the market is bad, whether, I don't care what the point value drop is, your first step is you probably need to reassess if you should be in the market in the first place. One day happens all the time, okay? So if you are panicking after one day, reassess how much you have in the market, because that can just lead to very bad decisions and lose you money. That's the first thing. Second of all, if you're the type of person to move out into cash and then move back into the market and then move back to cash, okay, you have to have a plan twice. So you're making your life a little harder. You have to have a plan of when to get out of the market. So if you have, when the market falls 5% or 10%, I don't care what your number is, Jim. I don't care what your number is, because I know what he's going to say. This is when I jump out, and I jump out 50%, okay? Then you also have to have a number of when you jump back in. You can't just say, oh, I'm out. But then when do you get back in? So that's the tough part, right? Because you ever hear the term, you don't want to catch a falling knife. So if you jump out when the market goes down 5%, then what do? You wait till it's 10%, but then what if it goes down 20%? So you have this issue here of having to be right twice. So we don't usually recommend jumping out and going to cash and then jumping back in, because that lowers your overall chances of being successful. In general, if you do have a lot of money in the market, it's probably just a good practice to have some money in cash. If the market goes down, you can buy things on sale, right? So you don't have to worry about, what do I sell now? And, in a panic, how much do I sell? And then when do I buy back in? And how do I buy back in? I don't know that that's overall a great strategy. Now, with that said, if some huge event happens, we have a 3-day rule, but for instance, like Brexit was not this year, last year. Yeah, so a year ago in June, Brexit was a big deal, and the market went down 600 points, 500 points, 100 or 200 points, and everybody's panicking, and not even a month later, it was probably like 3 weeks later, almost nobody was even talking about it. So this was this time where if you jumped out, when you get back in, unless you got back unless you got out the first day and got back in on the third day, you were completely wrong and you lost money. A big swing. I'm talking tens of thousands, hundreds of thousands, depending on your whole portfolio. So this is a big deal. That's why we don't really recommend getting out and getting back in. But if there's a catastrophic event, so something that we did when Lehman Brothers failed, Okay, so when a double A rated institution along with other institutions are going under left and right, this is a big deal. You might just want to jump out and get out of the way, okay? But that's not the plan I'm talking about right now, to just play market volatility. So getting out and going to cash and getting back in is probably not the best plan of action. So here are your other options. What are my other options, if I can't just go to cash and hop back in? So a stop loss or a trailing stop loss. Let's talk about this for a minute and what that means to people. So a lot of times a stop loss is basically triggers an order at a certain price to sell. So if I own a stock at $100 and I want to sell at 90, I can put a stop loss in at 90 for whatever the reason. Maybe you're uncomfortable at a 10% drop. Maybe you're protecting gains because you bought the stock at 50 and now it's at 100 and you just want to protect those gains. Whatever the reason, it's at 100 and you want to sell at 90. You put in a stop loss at 90. In a perfect world, okay, the stock starts to fall and it hits 90 and it sells at 90. There's a couple of issues with that. The first issue is liquidity. If the stock is not traded in high volume, so it's low volume stock, okay, orders really jump around. So you have to look at like the bid ask of an order to see what the range is. If it's like within a few cents, you're fine. Or something large like an ETF or the SPY or something large, you don't have to worry about volume. It's high volume. So because your stop loss will trigger the next order, whatever the next order is, whatever the next price is, that's where you're selling. So it may not be exactly at 90. It may be at $89.95. It may be at $90.02. So when it hits 90, it triggers to sell at the next price. The other major problem with stop losses is after hours. So unless you have like a Forex account or futures and you're all savvy in that, normal people, the retail people, trade between 9:30 and 4, okay? So after hours, you can't trade. So when earnings comes out after hours and the stock may open up the next day at 80, guess where you're selling? So even though your order is at 90, you would be selling at the next available order, remember? So if it hit that 90 mark after hours and it's going to open up at 80, that is where you're selling. So it still protects you, I mean, it's not foolproof, but it's better than it going to 30, so it still protects you. So what we have done is there's what they call a trailing stop loss. So you can put in a trailing stop loss at 10%. Some firms will let you change up the percentage. The basic one is 10%, but some firms will let you do, 15%, whatever it is. And the trailing just simply means the stop loss continually adjusts for where the price is at. So if it started at 100, a 10% stop would be at 90, obviously. If your stock goes to 150, take off 15 bucks, that's 10%, your stop loss is now at 135. You following? So it continually adjusts with the price when it goes up. So it's a way to kind of have that protection, but at the same time, you're not getting out if the stock continues to go up. Again, not foolproof, but this is an option that you have, for wherever you're trading for free, and your advisors have access to things like this. So make sure when you're talking with your advisors that they have a plan, no matter what it is, whether it's using stop losses or not in general, because they're not foolproof, but no matter what it is, even if it is going to cash, which I don't think is the best idea, but if it is, just make sure your advisor has a plan. And if you trust your advisor, you don't even necessarily need to know all the details. You just need to know they have a plan and they've had a plan in the past and they take action when the market does go down, because that does two things when the market goes down, right? You're protecting against losses and you're finding opportunities. So this is a huge swing when you're talking about the volatility of the market. And it happens. It's a guarantee. So why not try to prepare for that? We know the market isn't just going to go straight up every day for the rest of our lives. It's a guarantee the market's going to move. So why not have a plan for that? So stop losses is one way to do that, although it's not foolproof. It works a lot, like I said, with protecting gains. You have to keep in mind taxes on that too. If you're going to automatically sell a stock that you're up big on, you have to be okay with selling that stock and taking that gain. In my example of if you bought it at 50 and it's trading at 100 and it falls and you sell at 90, you're locking in that gain of $40 per share. So I really stress that you consult with your advisor, consult with your, tax accountants, anybody, hierarchy, anybody that is in your professional circle, and make sure that that is a right strategy for you. Okay, next one, moving on. I hope we're good on that. If you have additional questions, shoot me an email. Shoot us an email, go to our website, contact us, novawealthmanagement.com. Just hit the contact us button. Yeah, don't stress. Easier said than done. People are emotional about their money. So the second option is, speaking of options, when people hear the word options, they think immediately risk. But there's a lot of strategies that you can do with options that aren't necessarily risky. So put options is a contract. All options are, puts and calls, are just contracts. Essentially, it's an agreement between you and someone else that gives you the right, a put anyway, to sell a stock at a given price, at an agreed upon price, okay? And you're paying a premium for that. If you're the seller of the put, you're getting a premium for that, okay? So there's a reason to do it on both sides. But here today, I'm talking about buying a put. So what does this mean for you and your money? If you buy a put, if you're trying to protect your overall portfolio, the SPY is the ETF for the S&P 500. So the broad market. Very, very highly traded ETF and very high volume on the options. You can buy a put option on the SPY, and you can go out maybe 2-3 months, and it's not that expensive. It might cost you, maybe a few grand, depending on the size of your portfolio, obviously. But it's going to cost you some money. But the illustration that I ran today, it cost the client 1%, okay, of the whole portfolio. So just to give you an idea, it's not much. But what this does is, that would give you the right to sell those shares at an agreed upon price, at a predetermined price. So if the market did tank, you would still have that put option to say, well, I have the right to sell at this price, okay? Now, how does that protect your portfolio? Your portfolio, whatever you own, would still go down. It doesn't stop things from going down like a stop loss is. So this is a different way of thinking. Whatever you own in your portfolio would still go down, but this would make you money. So essentially, it would offset it. It'd be what we call a hedge. That's what they mean when we say we're hedging. Okay, you're trying to offset losses. So, although everything in the portfolio may be going down, it may not be things you want to sell. Just because the market is going down, you may not want to sell certain companies just because the market is going down. It doesn't mean the company is bad. It doesn't mean they're going anywhere. In fact, it might mean they're perfectly fine. They're just going down just because the market is going down. So this is a way that you can hang on to your current assets, especially if you're one of those clients that loves dividends. You don't have to sell something. You don't have to worry about the dividend and when the dividend pays. You can hang on to your stuff and buy the put to make you money on the downside to offset those losses. So this is just another strategy. I'm not telling you to run out and go buy a bunch of puts, okay? I'm just telling you to talk this over with your professionals, do some research, see if that's something that's right for you. This is something that's available out there for you. There's several strategies that you can do. The last one that I have is kind of a crazy one. I actually talked about in ETFs in my very first Finance Friday. But inverse ETFs, meaning they do the opposite of whatever it's based upon is doing. That might sound confusing. Let me clarify. So there's an inverse S&P 500 ETF, meaning in simple terms, if the S&P goes down 2%, this ETF would go up 2%. So it's the opposite. It's the inverse. Okay? So there's ETFs out there that you can buy, hey Lena, that will do the opposite. So if you're looking for, again, a hedge or a way to offset losses, or if you are just one of those people that is certain the market is going down, okay, you can buy an inverse ETF and make money when the market goes down. It's not that simple though. So here's the caveat and the risk with those. They have what we call time value of money. So the longer you own them, there's a cost for that. They're the way that they can do this inverse relationship is buying futures. Now, the technicals doesn't really matter. What it means to you and your money is when you hold these inverse ETFs, there's erosion in the price just purely because of time, okay? So you can't just hold it forever. They're not long-term investments is what I'm trying to say. If you think you're going to own it for maybe a month, 2 months, maybe 3 months max to try to play a trend, to try to say, well, I think the market's going down, I'm gonna buy it. You can do that, okay? But don't buy something like that and thinking you're gonna hold it for 10 years because the erosion of time gets to that price, all right? So different strategies that you can do in the options market and the ETF market and overall just in stop losses. And by the way, stop losses can be used not just on individual stocks, but they can be used on ETFs. They cannot be used on mutual funds, all right? So a lot of stuff we covered today, but I hope what you overall gathered from this is that you will panic a lot less if you just have a plan for when the market goes down, because it will happen. So if you just eliminate panic, you'll eliminate those decisions that lose you money and make you miss out on opportunities. Again, if you have any additional questions, please feel free to go to novawealthmanagement.com, reach out to me, contact us, shoot me an email. I have additional tips on our YouTube channel, or follow me on Twitter. I'm always tweeting tips on specific companies too, so follow me on Twitter at NovakovicAmy, and I'll give you my opinions on any companies that we have that come up, any earnings reports, things like that. So just in general, tips and tricks. But I hope you have an awesome weekend. Again, keep your prayers going for everybody in the wake of the hurricane and in the earthquake. Speaking of that, just keep your prayers going for all these people, and have a great weekend. Have a great rest of your Friday.